Hey there, future tycoons and money mavens. What's up, my people in the USA? Welcome to Money Talks US, the only place where personal finance is less painful than a hot wax and much more profitable, I promise you. All right, let's be honest. The word investment for many sounds like advanced Mandarin, differential equations, or even worse, having to talk to your know it all uncle at Thanksgiving dinner about his masterstroke stock picks. Yeah, it can be intimidating. You think of Wall Street, guys in expensive ties yelling numbers we don't understand, and charts that look like EKGs of a hummingbird on a caffeine bender. Many believe that to invest, you need to be the next Warren Buffett, have a PhD in economics from Harvard, or, at the very least, the ability to predict the future. And so, with that idea, most people end up stashing their savings under the mattress, where the only diversification is between $20 bills and $50. Spoiler alert, inflation eats it alive there. But what if I told you there's a way to put your money to work, to diversify your investments like a pro, and all this without needing to be a financial expert, without having to spend hours analyzing companies one by one? Sound too good to be true? Well, buckle up because today we're going to demystify one of the most powerful and accessible tools for the novice investor, the glorious, the magnificent, the sometimes misunderstood investment funds. Today, we're going to understand what they are, why they're your best friends if you're starting out, how they work, and what you need to know to avoid messing up. And hey, I know terms like mutual funds or ETFs are floating around out there. Don't worry. They're like the favorite children in the investment fund family, and we'll dedicate separate, detailed videos to each of them later because they deserve it. Today, we're focusing on the general concept of an investment fund, the parent idea, the big bang of your future fortune. Ready for your money to stop being a slacker and start bringing home the bacon? Then let's dive in. All right, team, let's start at the very beginning, as Julie Andrews would say in The Sound of Music, but with fewer songs and more Benjamins. What on earth is an investment fund? Imagine it like this. It's like a big kitty, a communal pot, or if you prefer a more American term, a financial potluck dinner. At a potluck, many people bring different dishes. Salad, chicken, pasta, dessert. No one has to cook everything, but everyone enjoys a varied and abundant meal. An investment fund works on a similar principle. It's a vehicle, an instrument, a kind of giant communal piggy bank where many investors, like you and me, pool our money together. This accumulated money, this common pool, is then managed by a team of professionals, the so-called fund managers. These pros, who are supposed to know what they're doing, and get paid for it, of course, take that big pile of cash and invest it in a variety of financial assets. What kind of assets? Well, it depends on the fund. It could be in company stocks, like Apple, Google, or that corner pizzeria that's publicly traded and you didn't even know. In bonds, which is like lending money to the government or companies in exchange for interest. In real estate, in commodities like gold or oil, or a mix of all of these. The key idea is that by pooling money from many people, the fund can access investments that would be difficult or very expensive for an individual to reach on their own. And, most importantly, it can diversify. That's the magic word we'll repeat tirelessly. So, in summary, 1. Many investors, hello, contribute their capital. 2. This capital is pooled into a common fund. 3. Professional managers invest that money in different assets. 4. You, as an investor, become an owner of a small part of that large basket of investments known as shares or units of the fund. Simple, right? Like ordering a pizza among several friends. Everyone chips in a bit of money and enjoys several slices of different flavors, instead of each person having to buy a whole pizza and eat the same thing for a week. Nobody wants to be that person, and neither does your portfolio. Okay, so we know what an investment fund is. Sounds good, right? But why should you care? What are the advantages of putting your precious money into one of these contraptions? Ah, my friend, this is where things get interesting. Benefit number one, the holy trinity of novice investing, diversification. If you've only learned one thing about investing, let it be this. Don't put all your eggs in one basket. It's the mantra of mantras. Imagine investing all your savings in shares of Pepito's Amazing Tacos Inc. If Pepito does great, party time. But if Pepito goes bankrupt because his tacos tasted like wet cardboard, well, you're out of savings and tacos. Tragedy. An investment fund, by its very nature, invests in many different assets. If an equity fund invests in, say, 100 different companies, and one or two do poorly, the impact on the total value of the fund is much smaller. The other 98 can offset that loss or even generate profits. It's like having a soccer team. If your star striker has a bad day, maybe the defender scores a wonder goal or the goalie saves a penalty. The team can still win. Diversification reduces your risk. Period. It's the easiest way to protect yourself without having to be a genius analyzing every company in the S&P 500. Benefit number two, professional management. Let the nerds do the dirty work. Unless your hobby is reading 200-page annual company reports or analyzing treasury bond yield curves, if so, my respects, but seek help, you probably don't have the time, knowledge, or inclination to actively manage an investment portfolio. Investment funds are managed by teams of professionals, analysts, economists, portfolio managers, people who live and breathe financial markets. Their job is to research, select, and monitor the fund's investments. They make the buy and sell decisions based on the fund's objective, which we'll discuss later. Basically, you pay them a small fee. Yes, there are fees, we'll talk about that, for them to do the heavy lifting. You get on with your life, and they try to make your money grow. A fair deal, if you ask me. Benefit number three, accessibility and affordability, investing for the people. Previously, to have a diversified stock portfolio, you needed considerable capital. Buying shares in dozens of different companies can cost an arm and a leg. But with investment funds, you can start with much smaller amounts. In the United States, there are funds that allow you to invest from $50 or $100, sometimes even less. This democratizes investing. It's no longer an exclusive club for millionaires. With what you spend on a couple of dinners out or on that new video game, you can become an investor and own a tiny piece of many companies. It's like buying a ticket for a luxury cruise by sharing the costs. Benefit number four, variety of options. There's a fund for every taste and need. The universe of investment funds is vast. There's something for every taste, color, and flavor. Are you young and adventurous, willing to take on more risk for the possibility of higher returns? There are aggressive growth funds. Are you close to retirement and looking for something more conservative that generates stable income? There are fixed income or dividend funds. Are you passionate about technology, renewable energy, or emerging markets? There are funds specializing in those. This variety allows you to align your investments with your financial goals, your risk tolerance, and your time horizon. It's like choosing a car. It's not the same if you need a sports car for yourself, a minivan for the family, or a 4x4 for an adventure. So there you have it. Diversification, professional management, accessibility, and variety. The four horsemen of investment fund advantages. Don't they sound so scary anymore? Okay, we're convinced that funds are the best, but as I said, there are tons of them. Although we're not going into the specific details of mutual funds versus ETFs today, patience, grasshopper, that's for another video, we can talk about the general categories of funds based on the type of assets they invest in. Think of it like major movie genres: action, comedy, drama, horror. 1. Equity funds, or stock funds. These are the Tom Cruises of funds, pure action and potential for big thrills and returns. They primarily invest in company stocks. When you buy a share in an equity fund, you indirectly become a part owner of all the companies that make up that fund. Their main objective is usually long-term capital growth. This means they aim for the value of your shares to increase over time. They are ideal if you have a long investment horizon, more than 5 to 7 years, and can tolerate market ups and downs. In the short term, they can be volatile, like a roller coaster, but historically, over the long term, they have offered the best returns. Think about it. You're betting on the growth and innovation of companies. 2. Fixed income funds or bond funds. These are like Liam Neeson in Taken, but the financial version, more predictable, seeking to protect and generate income. They invest in debt instruments, mainly bonds, whether issued by governments like U.S. Treasury bonds, the famous T-bonds, or by corporations, corporate bonds. When you buy a bond, you're basically lending money to that entity, and they promise to pay you back on a future date with interest. Fixed income funds aim to generate regular income through these interest payments and preserve capital. They are generally less volatile than equity funds, making them more suitable for conservative investors or those who need periodic income, like retirees. They are the anchor of a diversified portfolio. 3. Balanced funds. These are for the indecisive or the smartest, depending on how you look at it. They invest in a combination of stocks and bonds, and sometimes other assets. They seek a balance between the growth potential of equities and the stability of fixed income. The ratio between stocks and bonds can vary. Some funds might be 60-40, 60% stocks, 40% bonds, others 50-50, etc. They are a good all-in-one option for those who don't want to overcomplicate things by choosing different types of funds, or for those seeking a moderate risk profile. It's like ordering a pizza that's half pepperoni, half Hawaiian, a bit of everything. 4. Money market funds. These are the chickens of the coop, but in a good way. They invest in very short-term, very low-risk debt instruments like certificates of deposit or treasury bills. Their main objective is capital preservation and offering very high liquidity, meaning you can easily access your money. Returns are usually modest, sometimes barely beating inflation, but they are considered very safe. They are a good option for parking your emergency fund or for money you'll need in the short term and don't want to risk. It's like having money in a savings account, but sometimes with slightly better returns. Better than under the mattress, that's for sure. These are the major groups. Then, within each, there are subcategories. Funds that invest in large cap companies, mid cap, small cap, funds for a specific sector, technology, healthcare, funds for a geographic region, US, Europe, emerging markets, a whole world to discover. But with these 4 pillars, you already have a solid foundation. All right, we know what they are and the types. Now, the million-dollar question, literally, let's hope, how do they work in practice? How do I know what my investment is worth? This is where a key concept comes into play, the net asset value, NAV. Don't be scared by the name, it's simpler than it sounds. The NAV is, basically, the price of each share or unit of the fund. It's calculated every day at market close. Think of it this way. The fund manager has a big basket full of different assets, shares of company A, bonds of company B, etc. First, you add up the current market value of all the assets the fund holds. Let's say today, all those assets together are worth $1 million. Second, you subtract the fund's daily expenses and fees from that total value, because managers don't work for free, I told you. Let's say they're $100. So we're left with $999,900. Third and finally, this result is divided by the total number of shares outstanding among all investors. If there are 100,000 shares, then the NAV would be 999,900 divided by 100,000 equals $9.99 per share. This NAV is updated daily. If the fund's assets increase in value, the NAV goes up. If they decrease, the NAV goes down. When you buy shares of a fund, you buy them at that day's NAV. When you sell them at the NAV of the day of the sale. So, how do you make money? There are two main ways. One, capital appreciation. If the NAV of your shares rises above the price at which you bought them and you decide to sell, you make a capital gain. You bought at $10, sell at $12, you made $2 per share. Easy. Two, fund distributions. Funds can also generate income through dividends paid by the stocks they own or interest paid by the bonds. Periodically, monthly, quarterly, annually, the fund may distribute these earnings to its shareholders. You can choose to automatically reinvest these distributions to buy more shares, hello, compound interest, or receive them as cash. So, when you invest in a fund, you're buying pieces of that big basket, and the value of your pieces changes every day according to how the whole basket performs. It's like being a shareholder in a sports team. If the team wins and its value increases, the value of your share in the team goes up. Wow, you're almost an expert on fund theory. But before you run off to put all your savings into the first fund you find with a cool name like the Intergalactic Quantum Profit Rocket, hold your horses, cowboy cowgirl. There are some crucial things you must consider. Investing isn't a casino, it's a serious decision. 1. Your financial goals. Why are you investing? This is first. Do you want to save for a down payment on a house in 5 years? For your retirement in 30 years? For next year's vacation? Spoiler, for the latter, an investment fund might not be ideal due to the short term. Your goals will determine the type of fund and risk level that suits you. Investing for a short-term goal where you need to preserve capital is not the same as for a very long-term one where you can afford more volatility. Define your why. 2. Your risk tolerance. How much scare can you handle? We're all different. Some can see their investment drop 20% and sleep like babies, thinking it'll recover in the long run. Others see a 2% drop and are already calling their mom and panic selling everything. Be honest with yourself. How comfortable are you with the possibility of losing money in the short term in exchange for a higher potential long-term gain? If you choose a fund that's too risky for your personality, you'll live stressed and likely make bad decisions. There are online questionnaires that help you define your risk profile. Take one. 3. Your time horizon. When will you need the money? This goes hand in hand with your goals. If you need the money in 1 or 2 years, an equity fund is probably a bad idea due to its volatility. A money market fund or short-term fixed income fund would suit you better. If your horizon is 10, 20, or 30 years, hello, retirement, then you can afford funds with greater growth potential and higher risk, like equity funds, because you have time to recover from market downturns. General rule, the longer the term, the more risk you can take. 4. Fees and expenses, the elephant in the financial room. Investment funds aren't free. Managers charge for their work, and there are other operating expenses. These fees are expressed as an annual percentage of your total investment, known as the TER. It might seem small, 1% or 2%, but over many years, it can significantly eat into your profits. Pay close attention to fees. Compare similar funds. Sometimes a fund with lower fees can be much more profitable in the long run, even if its gross return is slightly lower. Watch out for this. It's one of the most important factors. We'll delve deeper into fee types when we discuss mutual funds and ETFs, because that has its nuances. For now, just know they exist and you need to monitor them. 5. Research the specific fund. Read the fine print. Every fund has a key document called a prospectus, or a summary called a key investor information document, or in the US, often a summary prospectus. Yes, I know it sounds like boring homework, but it's vital. There, you'll find information about the fund's objectives, its investment policy, what it invests in and how, risks, fees, historical performance, though past performance does not guarantee future returns, remember that, and who the managers are. Don't invest blindly just because a friend recommended it or because the name sounds cool. Take some time to understand where you're putting your money. It's your financial future at stake. If you consider these 5 points, you'll be much better prepared to choose the right investment funds for you and start your investment journey on the right foot. We've talked about the good stuff and how to prepare. But like everything in life, there are pitfalls along the way. So you don't stumble and take a financial nosedive, here are the most common mistakes novices, and not so novices, make with investment funds. Mistake 1. Chasing past performance as if it were the holy grail. It's tempting. You see a fund that returned 50% last year and think, this is the one, let's go for it. Careful. Just because a fund did very well in the past doesn't guarantee it will do well in the future. Sometimes those spectacular returns are due to very specific market conditions that don't repeat, or because the fund invests in a sector that was trendy and has passed its prime. Focus more on long-term consistency, the fund's strategy, and whether it fits your profile, not just the latest shiny number. Mistake 2. Ignoring fees or thinking they're chump change. We've mentioned it, but it's so important it bears repeating. That 1% or 2% annual fee might seem small, but the effect of compound interest also works against you with fees. Over 20 or 30 years, the difference between a fund with a 0.5% fee and another with a 1.5% fee can be tens of thousands of dollars in your final returns. Compare and choose wisely. Mistake 3. Panicking and selling during dips, the infamous panic selling. Markets go up and down. It's their nature. There will be moments of euphoria and moments of corrections, or even crises. If you invested for the long term in a well-diversified fund suited to your profile, the worst thing you can do is sell everything when the market falls. You'd be turning a temporary paper loss into a real, permanent loss. Often, the greatest opportunities arise after downturns. If your strategy is solid, stay calm and stick to the plan. As the saying goes, time in the market beats timing the market. Mistake 4. Not diversifying enough or fake diversification. But I'm already in a fund, so I'm diversified, you might think. Yes, a single fund already gives you diversification. But if all your money is in one fund, especially if it's a very specific sector fund, for example, Idaho Electric Scooter Company's fund, you still have concentrated risk. Or maybe you have several funds, but they all invest in the same thing, only large cap American stocks. True diversification might involve having funds that invest in different asset classes, stocks, bonds, different geographies, US, international, emerging markets, and different company sizes. Mistake 5. Investing without understanding. The know-it-all brother-in-law syndrome. Don't invest in something just because your friend, your neighbor, or that TikTok influencer told you to. Take the time to understand, at least broadly, what you're investing in, what the risks are, and if it aligns with your goals. If you don't understand it, ask, research, or seek professional advice. It's your money. You're ultimately responsible. By avoiding these mistakes, you'll already be way ahead of most. I promise. Now, I know some of you, the sharper ones, have been thinking, hey, what about mutual funds and ETFs, exchange-traded funds? Aren't those also investment funds? And you are absolutely right. Mutual funds and ETFs are, in fact, the two main and most popular types of collective investment vehicles that embody everything we've talked about today. They're like the star models within the big investment funds brand. Both mutual funds and ETFs pool money from many investors to buy a diversified portfolio of assets. Both can be actively managed by a manager trying to beat the market or passively managed, tracking an index like the S&P 500. Both offer the benefits of diversification and professional management we've discussed. But they have important differences in how they are bought and sold, their fee structures, their tax treatment in some cases, and their transparency. Mutual funds are the classics, the experienced old-timers. They are bought and sold directly from the fund management company, and their price, the NAV, is calculated once a day at market close. ETFs are the modern, tech-savvy youngsters. They trade on stock exchanges like individual stocks, meaning their price can fluctuate throughout the trading day. They often have lower fees and, in the US, are frequently more tax efficient for investments outside of retirement accounts. But don't worry, I'm not going to leave you hanging. Since each of these financial titans deserves its own spotlight and a detailed analysis, we will dedicate full, exclusive videos to each of them very soon. First, we'll dive into the universe of mutual funds, their pros, cons, when they're a good option, and how to choose the best ones. And then we'll do the same for ETFs, why they're so popular, how they work exactly, and why many consider them the superior option for individual investors today. So, if this video has whetted your appetite, make sure you're subscribed and have the notification bell on so you don't miss those future masterclasses. For now, the important thing is that you understand the fundamental concept of an investment fund, because that's the foundation upon which both mutual funds and ETFs are built. And that's all for today, future everyday Warren Buffetts. We've come a long way. I hope the idea of an investment fund no longer gives you cold sweats, but rather you see it for what it truly is, an incredibly useful and accessible tool for you to start investing, diversify like a pro, and put your money to work to achieve your financial goals, all without needing a master's in finance or being glued to a Bloomberg terminal. Let's do a super quick recap of what we've learned. 1. An investment fund is a pool of money from many investors managed by professionals to invest in a diversified portfolio of assets. 2. Its main benefits are diversification, the key, professional management, accessibility with little capital, and a huge variety of options. 3. They invest in different types of assets, mainly stocks, equities, bonds, fixed income, or a mix, balanced funds, plus safe money market funds. 4. The price of your share is called NAV, net asset value, and is calculated daily. 5. Before investing, consider your goals, risk tolerance, time horizon, fees, very important, and read the fund's prospectus. 6. And remember, mutual funds and ETFs are the prodigal children of this family, and we'll get to know them thoroughly in upcoming episodes. I know it's a lot of information, but believe me, understanding this is the first big step to taking control of your financial future. It's not about getting rich quick. That only happens in movies, and usually ends badly. But about building wealth consistently and disciplinedly over time. And investment funds are your great allies on that journey. If this video has brought you value, if you've learned something new, or if I've simply made you smile while talking about money, which is an achievement in itself, I would greatly appreciate it if you'd give me a big like. It's free and helps the channel a lot to reach more people who, like you, want to improve their finances. And of course, if you haven't already, what are you waiting for? Hit that subscribe button and activate the notification bell. That way you won't miss our next videos, where we'll break down mutual funds, ETFs, and many other topics to make you a personal finance whiz. Thanks for joining me on this financial adventure. Remember, the best time to start investing was yesterday. The second best time is today. See you in the next video. Invest wisely and go chase those dreams. Bye-bye.